Welcome. If you're someone who works, invests, or lives across borders, then this explainer is for you. We're about to break down the fundamentals of international tax.
This is the one question that connects pretty much everyone in the global economy. Freelancers in Berlin, investors with property in Italy, digital nomads, they're all asking this. And yeah, it can feel super complex, but it really doesn't have to be.
So, let's start that journey right now. The goal here is to turn all that confusion into clarity, and we're going to start with the absolute basics, like how do governments even get their money in the first place?
Okay, so there are really two main ways. Think of a direct tax, like your income tax, as an arrow. It goes straight from your pocket to the government. Simple enough. But an indirect tax, like VAT or sales tax, that's more like a boomerang. A business might pay it initially, but that cost just circles right back to you in the final price of whatever you're buying.
All right, knowing the types of tax is step one. But honestly, for anyone operating internationally, the million-dollar question is this: which country even has the right to tax you?
And the answer to that question all comes down to a concept called tax residency. This is the cornerstone of global tax, and it's so important because if a country considers you its tax resident, it generally gets to tax your income from everywhere in the world. That's a huge deal. Getting this right is absolutely critical.
So that's the big question, isn't it? What are the actual rules? How does a country decide, yep, you belong to us for tax purposes?
Well, countries use a few common tests. The most famous one is probably the 183-day rule. Spend more than half the year somewhere and you're probably a resident. But they also look at things like where you have a permanent home or where your life is really centered, your family, your social ties, your main bank accounts. And then, of course, there's the U.S., which has a totally unique rule based on citizenship alone.
And this is where things can get a little tricky. Because each country has its own rules, it's actually pretty common for two different countries to both claim you as a tax resident at the same time. So, what happens then? Do you pay twice?
No way. This is exactly where tax treaties come to the rescue, with something called tiebreaker rules. And the logic here is just brilliant. The treaty forces a decision by asking a series of questions one by one in a very specific order. It starts with the most solid fact: where's your permanent home? And only moves on if that's not clear. This process guarantees that in the end, you can only be a resident of one country for treaty purposes.
Okay, so we've figured out who can tax you. The next big piece of this puzzle is figuring out what they can tax. And it all comes down to where your income is actually generated.
And this really gets to the core conflict of all international tax. On one hand, your country of residence says, hey, we get to tax your income from all over the world. But then, the country where you actually earned that money, the source country, steps in and says, hold on a second, we have a right to tax the income you made here. This exact conflict is what tax treaties are designed to solve.
When you break it down, the rules for figuring out the source of your income actually make a lot of sense. If you have a job, the income source is where you physically do the work. If you get dividends from a stock, it's where that company is based. And for something physical like real estate, it's simply where the property is located. Pretty logical, right?
But what about income from a business? That's a bit different. It follows a special rule. It's not just about where you make a sale, it's about whether your business has a significant enough presence in another country for that country to tax you.
And that significant presence is determined by a concept called a permanent establishment, or just PE for short. Think of it like a threshold. Once your business activities in another country cross that line, that country gets the green light to start taxing the profits you make there.
So how do you cross that line? Well, having an office or a factory is the obvious one. But it could also be an employee who has the authority to sign contracts for you over and over again. And for today's economy, this is a big one. A service PE can be created just by providing services in a country for an extended period, often more than 183 days in a year. So picture a consultant working on-site with a client in Germany for 7 months. That alone could trigger a service PE, giving Germany the right to tax the profits from that project.
All right, now we get to the big one. We've seen how your home country and a foreign country can both lay a claim to your income. And that can lead to the #1 fear in international tax: being taxed twice on the exact same dollar.
Let's just be really clear about the problem. When two countries both tax the same income, that's double taxation. And without a fix, it would bring international business to a screeching halt. Nobody would do it. So how do we solve this?
Once again, tax treaties come to the rescue with two main tools: The exemption method is the simplest. Your home country just pretends that foreign income doesn't exist. But by far the most common solution is what's called the credit method.
And here's how the foreign tax credit works. Your home country figures out the tax you owe on your worldwide income. But then, it lets you subtract the taxes you've already paid to the other country. Now, the goal here isn't to pay zero tax. The goal is to make sure you end up paying the higher of the two countries' tax rates, but never, ever both.
So after going through all of that, what's the takeaway? Well, we've essentially just built a practical toolkit for you, a set of key questions that you can now ask about any international financial situation you're in. Here it is, all in one place. Number 1, am I a tax resident and where? Number 2, where is my income coming from? What's the source? 3, if you have a business, do my activities create a permanent establishment? And finally, number 4, how does a tax treaty step in to make sure I'm not taxed twice? These 4 questions, they're your foundation.
And that really gets to the heart of what this is all about. As the author of our source material, Loretta Zenonaj, puts it, the point isn't to turn you into a tax lawyer, it's about empowering you with enough clarity and confidence to ask the right questions and make smart decisions.
And of course, we have to include this important reminder, everything here is for educational purposes. International tax is incredibly complex and your situation is unique, so please always talk to a qualified professional.